Wall Street Week with Louis Rukeyser is made possible by the financial support of viewers like you and by Prudential-based Securities, the investment firm with rock-solid resources and market-wise thinking in the business of making money. Produced Friday, October 6. Our panelists are Ralph Acampora, Frank Cappiello, and Mary Farrell. Tonight's special guest is David Dreman, President and CEO, Dreman Value Management.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Well, this was a week in which we were reminded of the strengths of people and the limits of government. In East Germany, the crown jewel of Soviet imperialism, with the highest living standards behind the Iron Curtain, yet still a land where the theories of socialist economics have been given the test and failed miserably, thousands of the most economically valuable citizens eagerly seized their first brief chance to vote with their feet for freedom in what they had consistently been told was the cold, callous, money-grubbing West. The East German government, which this weekend had planned a proud celebration of 40 years in power, instead was haunted with mocking echoes reverberating from as far away as Tiananmen Square. But it was not just communist governments that were proving impotent and inept. Our own administration was forced to admit that it had had a chance to help the beleaguered people of Panama get rid of the tin-horn tyrant Noriega this week, but instead produced only a bureaucratic bungle in Washington. Similarly, back at the economy, the latest governmental effort to waste taxpayers' money in an effort to manipulate the international currency markets was foundering on the shores of human reality. This time around, as opposed to the last previous such episode, the would-be wizards of the Treasury Department had decided that the dollar was too strong, and in collaboration with like-minded functionaries in Japan and Western Europe, was spending dollars on every other currency in sight, trying to prove that they, the governments, were smarter and more powerful than the markets. At week's end, the score was markets 100, governments 0. And when it became clear that the international effort to beat up on the greenback was not prevailing, and that it would take even vaster sums of public money even to make a credible attempt, traders swarmed back into the dollar. It gained against all major currencies, despite the 7-government challenge, and the dollar's comeback in turn spurred the buying of U.S. bonds and stocks. Freedom can be an annoying thing if you're a power-hungry government official, East or West. And you know, that may not be the worst thing I have to report to you tonight. We tonight will carry on in this pesky mood by talking with a man who has been one of America's most successful investors by adapting a stance that he proudly calls contrarian. But first, let's visit the place that often seems confused about the difference between liberty and a loony bin, and see what actually did happen this past week in Wall Street. The Dow Jones Industrial Average surged to its biggest weekly gain in more than 16 months, and its 5th biggest ever, powered by reports that indicated a slowing but still forward-moving economy, and by whiffs of further mergers, including the longest ego trip ever offered by a U.S. carrier, Donald Trump's improbable and unsolicited bid to take over American Airlines. Gathering strength as it went along, the Dow set all-time records daily from Tuesday through Friday, closing at 2785.52, up nearly 93 points for the week. And every number you see here is a record, too, as the broader market indexes prove that this was far more than just a blue chip advance. The momentum has even captured a few of our L's, whose technical market index, after being stuck at -3 for 6 miserable weeks, edged up 2 notches to -1. There was no joy for gold and silver, which retreated, but the economic news, including a slight uptick in unemployment, and above all, the indomitable dollar, gave the bond market its biggest week in years and carried interest rates to their lowest levels since midsummer. But as the market waited eagerly for what it expects to be a new round of easing by the Federal Reserve, I don't want you to get carried away with euphoria, so I have two cautionary notes to offer based on reports published this week. First, be aware, the next time you're bellying up to somebody's bar, that only a third of the people in the U.S. say they wash their belly buttons daily. Lord knows what may be lurking down there. And on a more purely financial note, the class warriors of Congress might take a look at what it really takes to be rich in America today. To have the same spending power that $1 million would have given you 30 years ago, you now need at least $4.3 million. Frank Cappiello, tell us how to get it.
Belly button cleaner.
That's right.
That's the answer.
But this country needs a good 5-cent belly button cleaner.
Exactly.
So what do you think? The markets keep going up? Is this as far as they go?
I think the key is something you mentioned earlier, the dollar. They tried to sell the dollar down, and now we had 8 European countries raise their interest rates last week. That was supposed to put the dollar down. That didn't do it. So I think the next move is the Fed will make a conscious effort to put our interest rates down, and then with European interest rates up, that should give the dollar a little kick downward. And I think that's what the market is forecasting, lower interest rates, either a Fed funds rate reduction or a discount rate reduction.
The return on long-term Treasury bonds is now just above 8%. What would you expect it to be at year end?
I'd say another 75 basis points.
Well, that's
down.
pretty good, 3/4 of a percentage point.
That's the good news, the short-term good news. The bad news is longer-term, Lou. If higher interest rates develop in Europe, this means a slower world economy. And a slower world economy is going to hurt our exports, and that in turn will be something we'll be worrying about in 6 or 8 months.
Explain why the Europeans are raising rates when we're lowering rates.
Well, first of all, they're worried about inflation. They're also worried about the strength of the dollar. They're very disturbed about a strong dollar.
Why should they worry? It makes American products theoretically harder to sell. Why
That's
should
the way I
other countries
look
worry?
at it, yeah. I think what they're trying to do is to accommodate the Secretary of the Treasury, who's been on this dollar kick. The Federal Reserve really doesn't care about the dollar. They're more interested in fighting the inflation battle. But for some strange reason, they want to knock it down.
Well, I hope they're watching tonight. Mary Farrell, this market has shown remarkable strength. What would you expect it to do next?
I think the strength is remarkable in view of the earnings reports that are coming out. Certainly the earnings were terrific in the first quarter, slowed in the second quarter, and we've had a slew of expect to report disappointing earnings. IBM, the blue chip. So I'm surprised at the strength in the face of that. So I think the key here is, will the market be able to overlook another 2 to 3 quarters of very disappointing earnings and continue up beyond the valley, or are we going to see the correction?
Is this then the period of euphoria in which wise investors will begin to take profits?
If you have a short-term horizon, I think I would expect we'll have a correction here. I think it would be difficult for this momentum to continue. If you can see beyond 3 quarters, then I think we have a continuation of the bull market.
The contrary argument is that the market seems to be having its own rolling correction. Different groups go up at different times. Which group, if any, looks attractive to you now?
Ironically, I would stick with the consumer non-durables. You know, with slow growth economy, you have those are products that people will continue to buy. And
companies such as
Philip Morris, which has been a good performer. You know, your basic Merck, for example, drug company.
Some say Philip Morris is the new IBM, the bellwether of the market.
If it is, it's in good shape then.
Ralph Acampora is the only admitted technician here tonight. Would you give us your technical appraisal? Is this market getting ahead of itself?
Well, I agree with my panelist friends here, but I think the thing that's very impressive is this is October, and seasonally it's a bad month, and psychologically you would think that the second anniversary coming up that most people would be a little more apprehensive. Yeah, the strength of the market is one thing. I think what has been so very impressive over the last 12 months is individual stocks, Lou. You know, I'd say 8, 9, 10 months ago, I had no problems looking and seeing stocks with maybe 30, 35% potential, and at times not even believing that. Now I look at the same stocks or new stocks, and I see that the potential is not really there. I can see maybe 15 to 20%. So I'd say the market will continue. We're probably in the 8th inning. Bulls are 10 and Bears are 0.
Which are the likely 9th inning performers?
I think the same leaders. I think you're going to get a blow-off in the leaders, like the Disneys and the Philip Morrises and the airline stocks. And when you get that kind of an environment for a technician, it becomes very, very emotional, very irrational, and I guess maybe a time to lighten up.
We have a lot of viewers out there who were bright enough to listen to you fellows, and they bought some stocks when you thought it was a good idea. Should they be selling some stocks, and if so, which ones?
I think, obviously, it depends on the individual issue, but I think I'd be taking my foot off the accelerator. Not necessarily selling my entire position, but lightening up a little bit. As I said, there could be another 15, maybe even 20% in these stocks. And that 20%, I don't want to be a buyer. I want to scale into that. So I can't say I see very many vulnerable groups, but I see rich groups.
All righty. In any event, panelists, it's time now to say, as Shakespeare probably would have if he'd only had an IRA, to be rich or not to be rich? That is the question. Frank Cappiello, 3 weeks ago, as we reported, the financial markets were rocked by a series of false rumors, from a fake report that President Bush had been shot to another one that a major bank was going belly up. Rodney Small of Herndon, Virginia, notes that all this occurred on a day when many futures and options were expiring. He'd like to know how good a job has now been done by the exchanges in investigating where these totally unfounded rumors originated and precisely who profited from them.
Okay, Lou, the easiest way to answer this is to take an example. Let's take the New York Stock Exchange, take X company, that's the target of takeover rumors. Stock's up 10 points. The first thing that will happen on the floor of the exchange is the floor governor will go around and check with the companies. Is there anything to this rumor? If not, then he'll go to the market maker, the specialist, and he'll say, who are the brokers that are buying the stock? Then he'll go beyond that to the brokers, Merrill Lynch or what have you, and say, who are the people that are buying the stock in your shop? And sooner or later, they will track the culprits down. Now, if they can't do it, the SEC is also checking all the trades, and with their subpoena powers, they will come in and investigate. Sooner or later, they will get the person, and then he's liable for criminal and civil liabilities.
How long should it take them?
Well, on some cases, it might take as much as 6 or 7 weeks on a particular stock. On a rumor that President Bush has been shot, that's a little more difficult. You know, that's hard to track. I don't know whether we really found out who said that or not. Probably a bear.
I think that's a safe bet. Mary Farrell, how would you respond to Cassett Griffin of La Jolla, California, who writes me as follows? Rather than ask any of your brave panelists to stick their necks out and forecast what investments would most likely survive a future depression, I would like to ask what type of investments have been shown in studies of the 1929 depression to have best survived, both short-term and long-term.
Lou, I'm shocked that one of your viewers has so little faith in our crystal balls.
We have viewers of all kinds and all views.
The problem in the 1929-33 depression was deflation. Prices of everything, including stocks, were going down. The best investment was U.S. government bonds. They paid their interest while corporate bonds experienced a real default rate. Ironically, short-term small-cap stocks were up 142% in 1933. If you had a really long-term time horizon, a gutsy investor who bought the market, say put $1,000 in at the 32 low, would have over $1 million today after reinvesting dividends.
So the optimist won even then.
Yes.
Ralph Akampura, with the problem of crime on the minds of so many Americans, Vincent Kelly of Greensboro, North Carolina, thinks he sees a growth industry in the nation's prisons. They're already overcrowded, he notes, and may get more so as we pursue the war on drugs. He wonders about the prospects for investing in some of the new prison operations owned by private companies.
Lou, there's a very disappointing statistic. The United States has the 3rd highest incarceration rate in the world. Russia's #1, South Africa is #2, and we are #3. I think the Chinese must be listening to Confucius when he says, take no prisoners, because they're not on our list. But you know, there is one company, and it began in 1983. It's Corrections Corporation of America. It's an over-the-counter issue. CCAX is the symbol. They've actually more than doubled this year. Very much like the market, a little spiky, but looks like there's higher momentum. And I have something else, if you want to really take a hold of your portfolio, Lou. This little gadget was made by Smith & Wesson, which used to be an American company, Lear Siegler. Now it's owned by a British firm called Tompkins. I think it'll fit both bulls and bears, Lou. I have the key if you'd like to try it.
Thank you. If there are any panelists who commit felonies, I'll keep that in mind. Meanwhile, if you'd like to lock up some profits, we may have the key for a very long term. So stir yourself, you 3-time losers. We'll try to give you results of a different stripe. Just send your money questions up the river to us here at Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117. Now, before we meet tonight's special guest, who considers himself one of the market's true contrarians, let's see what that word means to him as we examine some of his rules for investing. Wary, wary, quite contrary. Rule number 1 is, don't be piggy. When you buy, pick a point to sell. And if the stock gets there, grit your teeth, brace yourself, and get rid of it. You probably will be unhappy if the stock goes higher, but you definitely will have made money. Second, he says, buy large companies. Ignore those clowns who tell you that small stocks are the only place to be. His rule is more than $1 billion in market value, because he believes those giants usually suffer less from accounting gimmickry than smaller companies. Third, consider high dividend yields a strong plus. Such dividends not only add to your total return, but they help support the stock in a bad market. Conversely, don't be tempted by glamour. Stay away from fancy glamour stocks, those with relatively high prices as compared with their annual earnings. When such stocks have an earnings reversal, their prices can be devastated. But realize that not all stocks with low price-earnings ratios will be winners either. Try to distinguish between those that are in a long-term downtrend and those just suffering temporary setbacks. The latter could give you your biggest payoffs. Last of all, be patient. You may have to wait 2 years or more for such an approach to pay off. Pick your own time frame, but stick to it. Can this method of acting au contraire have you shouting, oh boy, about your investing results? For some thoughts on that, let's go over now and meet tonight's special guest, David Dreman. David, hello. Nice to have you back.
Thank you very much, Lou.
Please have a seat.
Thank
David Dreman's company, Dreman Value Management, has been in the top percentile of investment counseling firms for the past 10 years. A money manager and securities analyst for more than 30 years, Mr. Dreman now manages about $4.5 billion worth of assets, as well as writing regularly on the financial scene. He is tonight making his second appearance as my guest on this program. David, do you ever get the feeling that everybody and his brother are calling themselves contrarians these days?
Yes, I do, Lou. And Contrarian now seems to run all the way from market timing to small cap to many, many other investment strategies. But the way we use it is very much the way it was just described, but buying big cap, low PE stocks.
As a true contrarian, what do you think of this market as its record tonight?
It's even surprising to me that it's gone up as fast as it has. After the crash, we went into, we became fully invested in early January of '88, and the market has done extremely well, but I would never have thought it would go up 7 quarters in a row and up 50%. So it's a little surprising that we've had this dramatic climb in this short period of time.
You are traditionally a tough judge of value in stocks. Are these stocks now overvalued?
No, I think there's a really very major difference between 1987 and 1989. Back in 1987, the earnings were well behind stock prices, and the Dow and the S&P were at about 22 times earnings. And that's only happened a couple of times in the past. One was in 1929, and then we had the great crash, and of course we had an even greater crash in '87 when earnings rose up there. But now we have earnings that have come up very sharply, so that price-earnings ratios are down to 13 on this year's earnings, and I think we have good, solid values in the market still. Interest rates are low, inflation is reasonably low, so I think there's still a fair amount of opportunity, and the market can go higher.
As you heard earlier in the program, we have people who are beginning to get a little bit edgy about being close to an end to this scenario. Would you still be aggressively buying stocks at this point?
Well, in our equity portfolios, we are 100% invested. I think the market has really become a minor two-tier market. In the one sense, everybody is buying the consumer products companies, and a Coca-Cola now trades at 20 times earnings, and a cyclical company, although we expect a soft landing, is really pushed down into the ground. So an automobile company, a chemical, or some of the other cyclicals will be at 4, 5, 6 times earnings. So
what are some of the specific stocks that look attractive to you now?
I think the autos, particularly Ford, is really very underpriced. No question there's much more Japanese competition, there's transplants, but here's a company that's quadrupled its earnings since the late 70s, trades today at a price-earnings ratio of 4, has a 6% yield, and even in a bad year has earnings that are only down about 10% from its record.
Okay, after Ford, where do you go? Or where do you go in your Ford, if you will?
Okay, after Ford, I'd probably go to companies in the technology area, particularly the computer area. Technology and computer stocks have really just been beaten down. When I was here a few years back, they were at high-flying multiples of 30, 40, 50 times earnings. Now we can get a compact, which is the BMW, I guess, of the personal computing industry, at something like 10, 11 times earnings with a 100% growth rate over the past 4 or 5 years.
Well, just from these two names you've given us, it suggests that the contrarian looks at the groups that the crowd's not looking at. Is that basically right?
We certainly try to, yes.
Well, let's look at a group that's here tonight, starting with Frank Cappiello.
David, how do you know when to sell in terms of not only just the market, but an individual stock? You set a target, but what energizes your selling to get out of the stock? What event?
What we do is we sell when the market hits, or our stock hits the market PE ratio. We buy stocks at low PEs, and when the market hits the PE ratio, which is about 13 and a half right now, Frank, that's the point that we'd sell at. And it's very often a difficult thing to do, but we grit our teeth, sell there, and very often see the stock move higher, but we made our profit.
Good enough.
David, you've obviously been very successful at picking out the low PE stocks that are going to get high PEs. What other fundamental factors do you look at besides PE as the most important?
There are quite a number, Mary. We look at growing companies. There are a lot of PE stocks that are low PE temporarily, but may very well go to much higher PEs because the E will fade entirely. So we want to have stocks with growing earnings, growing dividends, and we look at 5- and 10-year earnings growth and dividends and the likelihood that they will increase. We stress dividend, and we want to have our portfolio with a yield of 50 basis points or 0.5% above the S&P 500. And we also want to have strong companies, no more than 40% debt in the capital structure. Those are some of our important analytical rules.
Dave, I'd like to pick up on that theme you were talking about technology before. I happen to think IBM looks pretty interesting from a technical point of view. And what do you think of IBM versus, let's say, digital equipment?
Well, I think they're both interesting, and they're both very badly beaten down. IBM is a disappointing stock in that the earnings that should have been here this year for a number of reasons won't be in until next year and in a couple of years down the road. But IBM should be a steady 10% grower, I would think, after this year. Digital is more of a home run stock. I think the chances are that when it introduces its new high line end product line, that it would do very well. And digital has actually gone through 2 or 3 of these cycles. So I think that one probably will do well too, but the lower beta or the safer stock would be IBM.
David, you're completely outspoken about what you like. What don't you like now?
Well, I think some of the industries that have moved up quite a bit, I guess cellular is an area that is certainly very exciting, but it's again a concept area, just like the personal computing area was a concept area back in the early 80s. And there's no question cellular may grow at 100% a year for a number of years, maybe even higher than that. But it certainly is in the price of the regional bells and some of the other cellular companies. And I think the same would be true with some of the cable companies. And it's starting to look like some of the consumer products companies and some of the beverage companies are starting to get overpriced.
What's your view of the bond market?
I probably take a bit of a contrarian view here. We've got all the good news out on inflation, unemployment, and so forth. And it seems that interest rates are about as low as I think they're going to go. We have an underlying inflation rate of well over 5% if we take energy and agriculture out of it. And anything that goes wrong, any spike in the CPI or PPI, and I think we can see much higher interest rates. So we're really very short. Our maturities are in the year and a half range.
David, as I mentioned, you're a multi-billion-dollar investor, but in your emphasis on quality, in your emphasis on value, in your patience, in your desire for high dividends, you're like a lot of small individual investors. Is it a problem that individual investors are not going into the stock market at this point?
Yes, it's something that certainly concerns me, the idea that the crash really took a great number of individuals and had them leave the market. And individuals still, I think, will control about 50% of the stock in the country. So it's very much of a problem, and it's something that we should be focused on. It would be, I think, much more liquid. The market would have much more liquidity if we could get the individual back into the market.
What's the best way to bring him back, or her?
I think less volatility in the markets. And it probably will take time because after the crash, it's something that will probably take another year or 2 years. But more stability and time probably will bring the individual investor back.
And in your view, this market still has a ways to go in the 90s?
Yes, very definitely, but there will be some bumps on the way.
Thanks, David Dreman. It's always a pleasure to hear your lucid views and to talk with you about financial affairs. Thanks, too, to our panel. Hope you'll be back with us again next week. Then we'll look at one of the most controversial areas in investing today, the computer-driven links between financial and commodity markets and how they are affecting all kinds of prices all over the world. My guest, John Murphy, is a leading analyst of such inter-market action, and we'll be asking him to what extent the futures lie ahead. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser has been made possible by the financial support of viewers like you and by Prudential-based Securities, the investment firm with rock-solid resources and market-wise thinking in the business of making money. For a printed transcript of this program, send $5 to Transcripts, Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. That's $5 to Transcripts, Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. Wall Street Week with Louis Rukeyser transcripts are also available to subscribers of the Dow Jones News Retrieval Service.
News with a capital perspective tonight on Washington Week in Review. Next at 8 on Channel 10.
Wall Street Week with Louis Rukeyser is produced by Maryland Public Television, which is solely responsible for its content.